All right. Hey, everybody. Welcome to October 12th's issue discussion calls. So issue discussion calls are a new series that we are piloting at Maker. We use these calls to kind of bring together broad stakeholder participation to kind of focus in on an issue and really, depending on what it is, try to nail it down. And so today, I have the pleasure of hosting this wonderful call that's focused on the fixed rate solutions that have come about at Maker. And just as a brief intro to those solutions, there are currently three, and they are at varying stages of the governance process at Maker. The first one is the term lending module. This is associated with Yield Protocol, and Allan Niemerg is here as our guest representing Yield. And TLM actually was already ratified. I believe it's MIP 43 or 46. Don't quote me on that, but it's ratified. It exists, and it's currently in the backlog for actually being implemented in the protocol. Then there's DECO protocol, which is led by Vamsi, who couldn't make the call today, and his core unit is in the middle of his solution for fixed rates is in the middle of RFC for actually doing it through a core unit. So where the term lending module was proposed as a sort of technical proposal, DECO is being proposed as a whole development effort with its own independent team. And then the third and final fixed rate solution that the Maker protocol is considering is the Pairwyse solution, which is in the pre-MIP, pre-core unit phase. It's still in the discussion phase, basically. And the question is, the theme of this call really is, let me actually read it because I wrote it very carefully. Comparing solutions, figuring out what's best for the Maker protocol and its end users. So ultimately, the TLM exists, right? It's on the backlog. There is, in theory, a path for Maker to take to implement a fixed rate solution. But then there's these other two that are in the process of also being considered. And so to start off the call, I kind of want to give the guests who are Allan Niemerg from Yield and Akiva Dubrovsky from Pairwyse this open question. What are the properties that are most desirable for Maker in this fixed rate solution? Actually, I'm sorry, I'm not phrasing it exactly how I want. Let me rephrase it. Which approach? No, you know what? Let me approach it differently. How about this? I think the original plan for the call, let me stick to that, was actually to give each of our guests about 5 to 10 minutes to really do a brief overview of their solution. So yeah, let's do that. So Allan, do you want to start us off with the term lending module, since you have the voters already on your side?
Sure. I'm happy to talk about the TLM. But first, I wanted to say thanks, David, for having me on. I'm really excited to get to talk about fixed rate lending and how it can improve Maker. Maybe this is. Let me start by saying this. I actually don't think the TLM is a fixed rate solution for Maker vaults. So on one level, before we even begin, let me just say that it's maybe not even what we're discussing here today. And I can talk about why. What I'd like to do is just talk a little bit about Yield Protocol and the TLM and how it works, just so that you can understand the history of how we sort of proposed it as a fixed rate solution. But then I think also what with a little bit of time, we kind of understand better about what it is and actually its real potential, if you don't mind.
I don't mind at all. I think that's a brilliant idea, and I'm really fascinated. So yeah, let's do it. But I'm gonna set some ground rules. So you have, from right now, it's 12:07. You have 10 minutes. At 10 minutes, I will do a very non-aggressive sound like this, and that will signify to you that you have about a minute left. So yeah, you have about 11 minutes. So go for it.
Okay, great. So Yield Protocol was created with the idea of bringing fixed rate collateralized fixed rate borrowing and lending into DeFi. That was our goal, and that's what we've been building towards. And we started by trying to solve, I think, the simplest problem that we saw in that, or maybe a limited problem, which is, okay, we want to be able to do fixed rate borrowing and lending of DAI using ETH collateral. And so that's what we built in what I would call Yield Protocol version 1. We just wanted to show that you could do collateralized fixed rate borrowing and lending in DeFi, and using the technique that we had published in the original Yield Protocol paper. And that technique is, well, fairly simple, I guess, in the sense that, or maybe not, but it involves a user depositing collateral, minting a new kind of token against that collateral, where that new kind of token has properties like a zero coupon bond, and which specifically the properties are, it's a token that at some future date becomes redeemable for an underlying or base asset like DAI. That's it. And the power there is, what you can do with that system is you can do a fixed rate borrowing, because you put the collateral, you mint that token, and then you sell it for the asset that you want the fixed rate borrowing. And you sell it at a discount to the face value of that token. And the discount that you receive implies an interest rate. So if you sell if your token matures in a year and you sell it at you sell your Phi token at 0.95 DAI, for example, right? You've effectively gotten an interest rate of 5%, a fixed rate borrowing of 5%. And so that's just the general vision of what Yield Protocol is and how it works. And for version 1, we built it just addressing the ETH DAI situation. We borrow fixed rate DAI using ETH. And to make it all work and make it work well, we built it on top of Maker. So we're using certain parts of Maker in the back end. And after we did that, we sort of found that like the DAI lending market, at least for the fixed rate, felt very illiquid. That is, there wasn't necessarily like a lot of people out there that were looking to go buy a fixed rate DAI denominated bond. And that's sort of what led us to build the TLM. It's like, well, there's a natural party here that actually would like to own fixed rate bonds that pay in DAI, and that's Maker. And Maker has potentially several reasons for doing so. One, of course, is that it actually promotes the DAI ecosystem to create liquidity there. So that's useful. Another powerful reason that the Maker might want to buy fixed rate bonds in the space is to manage the yield curve in order to better maintain the peg. So thinking that through, and that potential there, that led us to create the TLM. But the TLM is actually a very broad and powerful technology. It's protocol agnostic. It actually isn't tied in with yield in any particular way. Yield would just be someone that could, or one sort of possible use case. And it's really flexible. That is, as long as you create a zero coupon bond like token that meets a very, very simple standard, your token could in theory be bought by the TLM. So it's very open and extensible. And it's also just very, very tied to, promotes Maker's objectives over, say, Yield Protocol's objectives. For example, let me say why. The way that it works is basically Maker can choose which bonds it might want to buy in the ecosystem, or bonds that correspond to that interface. And it can choose what interest rate it wants to buy them at, and then how much debt it's willing to take on to buy these. So it's really all in the control of Maker governance. They can decide, okay, we're willing to buy Phi tokens, zero coupon bond like instruments for DAI at 5% and only 5%. And then it would let anyone, sell those to Maker, of particular ones that it's already chosen it's willing to buy, at that rate. And then the TLM just holds it until maturity. So it holds that bond until it becomes redeemable, and then essentially what it actually allows is for somebody to come buy it back out of the TLM at face value, so that anyone can sort of close or respectively redeem the bond on behalf of Maker. And that's it. Like it's really simple. It's really open. It's really extensible. And that was just sort of an easy. It felt like the easiest way to implement it. But it means that yield protocol is just actually one use case for the TLM, and others could in theory be built on top of it. So I think that with time passing since we proposed it, and the ecosystem evolving, I actually think there's other use cases that might ultimately be more interesting, or interesting in addition to just the yield protocol one. So I think that's an exciting and interesting possible thing we could get into greater detail. Just to summarize, yield protocol, we're building fixed rate borrowing and lending. We think DAI is a very important part of that. And we think the TLM could be really useful to sort of encourage that the fixed rate borrowing and lending part of things, but also a bunch of other use cases. So I'm really sort of excited about how the TLM can address the use case we want to talk to today, but also many more. And I can talk about that a little bit as we go on, or maybe we can set that aside and sort of focus on the agenda we have for today. But that's my basic spiel.
Yeah, sweet. And you hit it within time, and that was really fascinating. I do want to say, if anybody has questions, feel free to add them in the chat. Typically, we'll hold them for the end after everybody kind of has their moment to explain their protocol, their solution, and then we're going to transition into a more discussion based segment for the rest of the call. So yeah, definitely add those questions. And also, I'm happy to pause here just for a moment to see if there's any top of mind, really urgent questions that anybody has. Actually, there's one from Akiva. Does the TLM use the surplus buffer?
Yes, the TLM does use the surplus buffer. So the TLM buys, as I said, these Phi tokens at a discount to their face value, and eventually they become redeemable. And so a surplus is generated, and that surplus goes to the surplus buffer.
Oh, in that sense, so it generates surplus. Well, yeah. I think because this question was on the other side, if it uses the DAI from the surplus buffer for anything. Yeah.
No, the TLM just simply makes money. It doesn't actually spend any money.
Got it. I think also his question was from the context of potentially needing DAI liquidity behind FY DAI, which I know part of TLM's model is actually from the Maker protocol standpoint, it takes the FY DAI in series and it generates DAI against them, and that's where you get that liquidity from. And so you actually kind of solve the zero coupon demand problem by just letting Maker be the liquidity there.
That's right. So behind the scenes, maybe it's a little bit technical, but the way that it works is Maker approves a particular type of Phi token, a particular zero coupon bond that it's willing to buy. And when it buys those, it goes into a special TLM controlled, join, or which is basically just a bucket that those bonds go into, and then but it can borrow DAI at face value against it. Or I guess it's not face value. It's it borrows DAI at the interest rate set by Maker governance, right? It generates those DAI and then it gives it out, as the purchase price. So no, that doesn't come from the surplus buffer. It's just it uses the core mechanism of Maker in order to generate the DAI that's used to purchase the zero coupon bonds.
Yeah. All right. Cool. And then there's one more question from Frank Cruz. What would happen if DAI becomes insolvent in yield protocol? Does it mean that FY DAI would need to be redeemed first during emergency shutdown?
Well, this maybe I think raises a question that I should have perhaps explained in my moment, but it eluded me. There's the existing protocol that we have today, yield protocol V1, which is built on top of Maker. And since all the assets in yield protocol V1 are held basically in Maker, the sort of emergency shutdown approach that we had in mind was basically like Maker governance figures out what to do with things. The thing with yield protocol version 1 is it's actually a limited lifespan. It ends at the end of this year, so it doesn't live much longer. And we're about to launch yield protocol v2, which is actually quite a bit different. In yield protocol v2, we're no longer built on top of Maker, and the key things we're trying to do is permit other kinds of fixed rate borrowing and lending for collateral. So you could, in theory, have USDC fixed rate borrowing and lending via our protocol. In that case, for v2, which I think is going to be, which we think is the future of the yield protocol, it's quite different. I mean, when Maker would be buying Phi tokens, they're essentially buying, something that's subject to the control of the yield protocol, and therefore, you do have protocol risk, right? So there is some risk that the Phi tokens that Maker buys may not be paid back because there's a hack or something in yield. So that would be something that should be sort of considered whenever a governance process is initiated to add, say, a yield protocol Phi token, Phi DAI as something it's going to buy. That doesn't actually need to be figured out in order to launch the TLM. The TLM, since as I said, it's protocol agnostic, can be launched without actually even thinking about the risks of yield protocol. But if you decide, if Maker governance decides, hey, yes, we actually do want to buy these Phi DAI bonds from yield, then at that time, it's entirely reasonable to just look and think, okay, what's the risk that yield protocol can't pay back this DAI in the future?
Yeah, cool. So the short answer to that is that during emergency shutdown, there is some risk that Phi DAI can't cover. So just for the audience watching, emergency shutdown is something that Maker voters can trigger, and it basically creates an unwinding of the whole protocol. So DAI becomes, all of the Oracle price feeds freeze at that moment of emergency shutdown, and DAI becomes a claim on a pro rata portion of $1 of collateral. So that's kind of what happens, and yeah, it's curious to see what what would happen to Phi DAI in that event. Like, presumably everything on the yield system and DAI, like nothing really would be broken. It would just be the price would not be par, and then DAI would just need to be, it would be redeemable basically.
Right. I would have to give this more thought, but my initial reaction is just as you said. That is, the yield protocol should continue to work fine. I don't think it would break because DAI would still be an ERC20 asset that you could, freely move around. It would just no longer be fixed at the peg. That shouldn't have, I don't think, an impact on yield protocol. It may have an impact on the users, but not the protocol itself, and I don't think would affect the soundness of the protocol itself.
All right, cool. So let's transition here, and let me give over the mic to Mr. Akiva Dubrovsky from Pairwyse, and feel free to introduce yourself.
So I wanted to say thank you to David for having me here today. And let me tell you a bit about myself and what I think Maker should be looking for in fixed rate protocols. I mean, a bit about myself. Before this project, I worked at KPMG, and one of my jobs there was to actually communicate the policy to the partners on how to avoid conflicts of interest in blockchain. So pretty much, conflicts of interest are a major issue in all businesses, especially in financial services. Pretty much anybody who understands the nature of big business understands that, conflicts need to be searched for, and conflicts of interest, are an impediment to good business. What I believe is that part of that is actually very well understood by regulators. So regulators have for a long time tried to enforce separation of, in Canada we have what's called separation of the pillars, where different segments of the financial services industry are separated from each other. Originally that was going back all the way to the Great Depression, the early 1900s, when commercial banking and investment banking were merged together, and that the culture of investment banking permeated into commercial banking, which allowed for the low cost of capital. And then that part of that was what largely created the Great Depression. That's what created what Paper Imperium was pointing out in the forums, was the Glass-Steagall Act, where there was this idea in many regulators, Canada, US, and Europe, that you need to keep the pillars separate, and that's one of the ways you prevent conflicts of interest. Now, what we believe is that even today, regulators, even though the Glass-Steagall Act was repealed, there's still been criticism of the financial sector, where conflicts of interest exist because of commercial banking and investment banking. So what we see is that Maker we see it's not a bank, obviously, but it does parallel the commercial banking world, where DAI is almost like, it's not a deposit, but it's similar to a deposit. And what we see is that we want to keep separate the commercial banking and the investment dealing aspects of DeFi, because what we believe, after a lot of research, is that regulators do also want to keep the pillars separate within DeFi, and that is necessary to prevent conflicts of interest. It's necessary to prevent a culture in which cartels form around different financial systems. I know what I wanted to say is that my background is really focused on snooping out conflicts of interest and maintaining proper integrity in business, so as to avoid that. About my project, our entity is separate. We're not planning on asking for any money from MakerDAO. We believe that if we're going to be in a business which is going to generate profit, we're not going to ask money from MakerDAO, because that would be commingling of the pillars, and we think that would sacrifice on integrity. Our product is a fixed rate product. It's a floating to fixed product that solves asset liability issues for Maker. We're on mainnet with a small amount of money, and we're continuing to go to market over the next few months and plan to scale up. Now, like I said, we're not asking for money from MakerDAO. We're not even asking for anyone to change any pieces of code. All of our code actually integrates kind of seamlessly right over the Vault and DAI systems that already exist today. So we were able to deploy everything on mainnet without even any integrations. It was all done permissionlessly, just by integrating with the ABIs. We did notice, like Allan said, that there is the demand for fixed rates is not as strong right now for a number of reasons. One is that if you approach people who currently have vaults open, what they'll say is, okay, well, why do I need to worry about a fixed rate if there's a $3 billion surplus buffer? If there's billions of dollars in the surplus buffer, that's almost like a protection against the DSR, because the DSR can't move while the surplus buffer is there. So we're not planning such an aggressive marketing or launch for the time being, partly because we just want to get low millions on the platform, and then as the DSR starts to move over the coming months or the coming years, that's when we're really going to look to scale. And that's the strategy which we've had really for quite some time now, and that's what we plan on pursuing. I think that gives a good summary. We focus on minimizing conflicts of interest, or preventing the formation of cartels by keeping separate pillars of investment dealing and commercial banking. We're funded independently of Maker, and the last thing is that we own the intellectual property for converting floating to fixed on MakerDAO, and that's been granted in Japan as of a few months ago, and it's pending in more countries as well. And after that, I'd like to open it up to questions, see if anyone has anything to say about it.
Thanks, Akiva, for that synopsis. Yeah, really interesting. I'm gonna give it to anybody else because I heard somebody's mic flutter. Anybody have any questions?
I was just curious if the speaker saw any benefit in like there being multiple fixed rate solutions within the protocol. Like, you know, do you see any interactions between the different ones we presented here, and like just more philosophically, like good thing, bad thing? What do you think?
Yeah, I think yeah. So money supply hit it pretty well. You know, I think the TLM is a great addition to Maker. I'm a big fan of the TLM. I think who knows, maybe one day I'll be using the Pairwyse the Pairwyse product will use the TLM. Who knows? I think the TLM is good, and I think it can work well with what I'm doing. And to answer Frank's question, does Pairwyse use the surplus buffer? So we don't touch the surplus buffer other than the fact that the revenues from the vaults go into the surplus buffer. So we don't really touch it so much. But yeah, and to answer Monet supplies, like I think we could potentially put like FRA bonds into the TLM. That's a great solution. Yeah.
Yeah, and I'd like to answer that as well. At first, Akiva, just to close your thought out, the TLM probably could work with your guys' system. I'm not super familiar with it, so I'm happy to take a look. I mean, it's but we tried to make it as sort of, as I said, protocol agnostic as possible. So if you have something like a zero coupon bond, it could probably be made to work. In terms of the question about having multiple fixed rate solutions, I think it absolutely makes sense to have multiple solutions in the ecosystem. For sure. I mean, I think that like having lots of people trying different ways to make DAI great is valuable. Like that's I think one of the amazing things about decentralized protocols is that you can you know, not only can they do cool things, but then people can build on top of them and do cool things. So really, maybe the question is just like, you know, should fixed rates be something that is, say, natively integrated within the Maker protocol, or something left out into the community? And on that, I actually, honestly, I think that the right answer is just, you know, what makes Maker better, honestly. If there's a reason that you need to, and I don't think you need to integrate fixed rates, borrowing and lending to make into the Maker protocol natively to make it great. But I know that there's definitely a lot of interest in doing so. If it solves, you know, key problems for users for Maker to do that, then great. I think that's fantastic. I don't think we should do it. You know, I think one thing I was thinking about this, and just this problem that I'd like to key on is, I don't think the decision should be like, you know, or the way to think about it is, oh, well, Maker needs fixed rates, therefore we need to integrate something in there, or, you know, just because we need it, you know, therefore we should build it into the protocol. That's probably not a great consideration and could lead to a poorly designed product. And second of all, I don't think that it should be done just to like, oh, well, you know, this would be a way to raise the TVL of Maker. I think that's a poor way to think about what Maker is succeeding. You know, one of the great things about stablecoins, about Maker, is, you know, TVL is not really important. You know, Maker's success, I think, is when the Maker ecosystem, the Maker economy perhaps grows. You know, I'd like analogize it to like GDP of a country, right? Like what you want to see is lots of DAI out there being used and turned over by lots of people. That's success for Maker. Not TVL, not how much is in Maker properly. It's, you know, having DAI out there and having that DAI be used. And that can be done, you know, that can be improved by a core part of Maker being, okay, now we have fixed rate vaults, you know, lots of people are using. That could be one way that you get there. Or it could be, you know, we're supporting community built solutions to do that through many different ways. So with that in mind, you know, with that, I think, form of success, I think multiple ways to do fixed rates in space, you know, can be really, really great. The limiting factor, obviously, is probably things like, you know, do we have the dev resources to do various things? You know, do we have the mental bandwidth, you know, core units have the mental bandwidth to get various things done, which is something, you know, beyond my ability to comment on. But I think that in terms of what does the Maker success case look like? Yeah, I think it's probably like supporting lots of different ways where you have different solutions that address different users' needs.
Yeah, actually, just to tack onto that, one interesting comparison piece between actually Pairwyse and the other two solutions is that on Pairwyse, you can have like custom FRAs. So like OTC, you can kind of agree on custom terms, whereas the other two solutions kind of have more fungible pricing strategies or like market discovery pricing strategies. So like I can imagine a world where on the one hand, like a Pairwyse FRA is one tool that could be used, but also a more standardized fixed rate solution can be too. And really, it's just whether you want to set a custom rate with a specific client, or if you want to kind of buy into the market set rate or the governance set rate, whatever it is. But yeah, just thinking out loud.
Hey everyone, I have two questions, probably for each. So I'm curious. So for the Pairwyse, as much as I understand where these two proposals differ, is that TLM depends on MakerDAO being the counterparty. So basically, MakerDAO is the lender, whereas at Pairwyse, as much as I understood, they're external lenders basically. So there's probably a question for Akiva, and I'm curious. You mentioned that the borrowing fix would be as appealing right now, but I'm also wondering what about the lenders, right? Because you have this yield farming going on. The yields are pretty high nowadays, or maybe now they're lower, but definitely 10% and higher. Who on the lending side, as an external party and not Maker, would actually be willing? How big is actually this market to find lenders? Lending at 2-3% for 6 months or 12 months. So that's one question I have for Akiva, and the second one for Allan. You mentioned the protocol risk that Maker would face. So there are dependencies, and I guess same holds for Pairwyse as well. But I'm curious, what's the magnitude of this risk or dependencies, right? So is there, as much as I understand, the TLM, the MakerDAO buys loans from yield protocol. So we'd actually need to evaluate, every single aspect of yield protocol. So how the auctions work, how do you set up parameters? Is there a governance token? All these kind of things. So that's kind of crucial here as well. So yeah, these are the main two questions probably I have.
So for my side, I can address that. I think the two questions are even somewhat connected. I think, with all DeFi protocols, there's always the smart contract. Smart contracts are not always perfect, but I will say that we recently just engaged PeckShield, which is one of MakerDAO's auditors, and they're going to be auditing our smart contracts over the next few weeks. So, and I wanted to say on the other point about lenders. So, that's actually a good question. It's a very good question, and the way I see it is that we have relationships already with crypto investment banks, and we're developing more of those relationships so that we can target lenders and or corporate treasuries who want to secure some yield and aren't as interested in yield farming. So the way I see it is that yield farming is very attractive for some people because it's very high yields. There's also credit risk in yield farming. There have at times been very sharp drops, and in some cases they're having credit losses. It's been not that common, but some people can't risk the credit loss. And the way we see it is that when we're sourcing those lenders at, like you said, those low interest rates, those lenders all have the benefits of the surplus buffer. So this ties back to the surplus buffer. If Maker has 55 million in the surplus buffer, and that is all junior and subordinated and taking the first loss against credit losses against the whole DAI supply, that exists on our platform as well. So that's actually what led me to do this. Was that I asked, could I put the surplus buffer to good use and put Maker's creditworthiness to good use. And what we see is that, you know, we want to source lenders who like the fact that they have the surplus buffer backing them up, you know, as a credit support and credit enhancement system. So, you know, and it's not just that, we plan on collaborating, and we already are collaborating with MakerDAO's ecosystem to source those deals. And, you know, as far as I can tell, if MakerDAO wants to go and build this, well, actually already is building and will continue to build this large financial institution called MakerDAO, you know, there has to be places where they can get DAI users from. And, you know, I think part of that is sourcing DAI users who want to have the good creditworthiness of MakerDAO and at a fixed rate. And, you know, I think when the DSR was first announced, which was in the summer of 2018, if I remember correctly, from what I remember, you know, a lot of it was thinking about targeting corporate treasuries. And, you know, so as far as I can tell, it's incumbent on us to work together with MakerDAO's team and my own team to source those lenders, and that's how we build a successful ecosystem.
Yeah, cool. Thanks.
Yeah, and I'm happy to also answer that question. I mean, first, you had the question of, you know, who would be the lenders at 2% to 3%? You know, with all this yield farming, who wants to lend at that level? And actually, that's exactly what led us to create the TLM. I mean, we were seeing when we launched Yield Protocol V1 that there wasn't a strong interest at that time to be a lender at what was considered a relatively low rate. Like, you know, people were looking for yield farming to receive returns of like 20% or something like that, you know, quite high. And so, you know, just thinking that through, well, like, who actually can lend in this space, you know, DAI at 2%, 3%, 5%, or whatever, you know, Maker can, and actually I think is at least, you know, it makes a lot of sense for it to do so, because, you know, that grows, you know, total DAI usage in the ecosystem. So, I mean, exactly that logic, who's the lender is what led us to create the TLM, because Maker really, I think, makes a lot of sense as a lender in this ecosystem. It can really sort of grow the DAI, or it has an incentive to grow the DAI lending ecosystem, even at rates of, like, you know, that are considered low by yield farming standards. So you know, I think that question totally ties in with why we created the TLM. On the second question regarding protocol risk, you know, I mean, I think it's absolutely essential that, you know, whenever you know, do something that ties you with another protocol, that you do look at the protocol risk. That makes total sense. You know, for yield, of course, we're doing all the things you would expect. Like, you know, we've had 2 audits for our protocol version 2. Our first protocol had at least 1, maybe more. The TLM has been audited. You know, and you know, for yield protocol, we're of course holding collateral for all the loans that we're issuing. So all the FIDI would be backed by collateral held in the system, and of course we have a liquidation system that's not terribly different than Maker's own liquidation system. But you know, all those things said, you know, there's still risk, and I think the way you manage that risk, especially with the TLM, is through the debt ceiling mechanism, right? Like, you limit how much exposure, you know, Maker has to any particular, you know, zero coupon bond, or at least to any particular protocol via zero coupon bonds, and then you raise that perhaps over time as you feel more and more comfortable with your counterparty. I mean, I think that's a very simple and effective mechanism that's built right into the TLM. And in truth, the TLM doesn't actually require, at least to put the TLM in place, which we haven't done yet, like the basic module. You don't even have to look at yield protocol risk, because the basic module itself isn't tied to yield protocol. As I said, it's a very open and extensible piece of software. You know, it can be used by 5 tokens. I noticed you're raising your hand. I'll wrap this up. You can use it by 5 tokens from anyone. So you know, we can launch the TLM without having to do some big risk assessment of yield protocol. It's really just looking at that individual code. Later, you could decide, you know, if you decide to add yield protocol to the TLM, then, you know, that decision could be made.
Sorry, just one before you go, David. when I was referring to protocol risk, smart contract risk is, of course, important, but I was more referring to governance risk. So how are your two protocols, being governed? So what's the execution? Is there a community? Is there a token? These kind of things.
Yeah, I'm happy to answer for that for Yield Protocol. For version 1, we had no governance. The smart contracts were designed to be deployed on chain and then just to run until December, at the end of this year, and then expire basically. For Yield Protocol version 2, we don't, we're first for the launch, the immediate launch, we're going to have like relatively tight control over it from the devs. I mean, we'll have a time lock in place so that we can't, just like run off the money with the money instantly. But at first, devs will be able to make changes. Then we intend to slowly transition to a multi-sig, and then transition on to even more governance-based ownership, community-based ownership. Excuse me.
Hi, can you guys hear me?
Yes, Frank.
Oh, okay, sorry. So following up on that question by Primoz, good questions there, Primoz. How important do both of you think it is for Maker to have a monetary policy, to be in control of fixed rates, right? Do you guys think it's important at all, or it kind of falls to what Primoz is saying. So I guess I'm just wondering, it just popped into my head, how important is it for Maker to have control over such, since we don't have a monetary policy in place?
Yeah, I would love.
Can I actually add to Frank's question? So it's interesting because TLM, Pairwyse, and Deco have different methods of like rate discovery. So actually go for it, Allan. You can answer the question as is. I won't tack anything.
Yeah, I mean, so I think thinking about Maker's monetary policy is super important. And in the TLM, we sort of put that in Maker's hands, right? Because Maker can set an interest rate at which it's willing to buy loans. And so has absolute control over that. In theory, you could, a future version of the TLM could allow Maker to sell those loans at some rate too, perhaps permitting Maker to use the process of buying and selling term loans as a way to affect monetary policy. And I think that to me is a really exciting future because, first of all, I think that I think it's likely that the DAI-denominated debt market and will grow considerably and grow on chain considerably. It's very small today, but I think it will be very big. And so then I think that in the long term, using that market and affecting rates in that market by trying to influence them or setting the rates, perhaps I suppose, will be a powerful tool in the toolbox of Maker. And when we were building the TLM, we were especially looking forward to that future and thinking, how can we build a tool that can be a step in that direction and can at least start to give deeper insights into how to use the setting long-term rates as a way to better improve monetary policy in Maker.
Yeah. So the way I see it is that actually setting fixed rates is absolutely essential for MakerDAO. It's a pretty simple exercise. You can just go and talk to the different people who are involved in the RWA stuff, like whether it's an agent who's helping facilitate a transaction with Maker, whether it's the end client who has a lending company. It's really simple. You just ask them, can you afford DSR exposure? And the answer, it's always going to be no. It's complete no. So as far as I can tell, it is certain that nobody who's in the RWA business anytime soon can accept a DSR term in their facility, in the credit facility. Now, on top of that, what I would add is that this is something we've been talking a lot about in the forums, and I've been happy to see some good interaction from Maker to respond to this. Is this idea that once you're decentralized and you want to have a fixed peg and you want to set fixed interest rates, you're at a tension, and because you can't set interest rates and have your fixed peg, and this is something we've been trying to draw attention to, where it's an asset liability management issue. And the way I see the answer to it is there is a fourth part of this trade-off, and it's actually the maturity and the tenor of each contract. So, if Maker wants to set fixed rates, that's for sure, and you want to keep the peg, that's for sure. Then the last tool you can use, which is actually a tool that's used in every financial institution to manage the assets and the liabilities, is to control the tenors and the maturities that you have with your clients. So if Maker wants to set peg DAI, that's good. If Maker wants to keep it decentralized, that's good. If Maker wants to offer fixed rates, that's good. So in the final tool, once you've chosen all of those three, is to build an adaptable and flexible asset liability policy, which sets tenors and maturities to allow for capital flows in and out of MakerDAO, such that everything can be maintained in equilibrium. And that's really the result of a lot of research that I did into this when I first started this project. And I want to give a shout out to MakerMan, who in the forums really picked up on this as being, and also in the calls as being really quintessential to everything MakerDAO does. And that's what we see as being the solution. And I think that it's very promising to see the future that way.
So I'm as a person who's not mega inundated with like this knowledge on fixed rate protocols and all this stuff, I'm curious, like for the rate discovery, right? Like it sounds like what you're saying is, yes, it's important for Maker protocol to set like these fixed rates, but the way that it does it is not by setting the rates directly, but it's by controlling the tenors and maturities. Is that what you're saying? So is it still fundamentally like a floating like market discovery, like rate market? Like a free floating rate market. I mean, sorry.
You have to offer a fixed rate. That's for sure.
Yeah.
The maturities and the tenors can actually be used to control the peg. So what banks do is they'll create a ladder of assets and liability that looks like these lines that are overlapping each other. And in doing so, they maintain cash flow in and out of the institution in a stable way. Now, doing that actually allows you to maintain the peg in a stable way, and that's what we see as being the answer to the impossible trinity that Maker is facing, where you kind of want to have your cake and eat it too. You want to have all the features of your ideal currency, but but you're sort of faced with these very essential drawbacks. So, pretty simply, let's say you get a client who wants to open a vault, and their collateral is super safe. So you say to them, okay, I'm going to offer you a low rate. You can only accept a fixed rate, and it's super safe collateral. So you charge them a cheap interest rate. So you do that, but now your monetary policy goes off, and now the DAI peg goes off, and now you have to raise the DSR. So now you have your hands tied behind your back because you just promised your client a fixed rate because their collateral was so safe and such a low rate. Meanwhile, the DSR is going all crazy. So how do you deal with that? And it is a bit of a situation where it's an asset liability issue. But what we believe is that it is possible to have fixed rates and a stable DAI peg, as long as you maintain that ALM policy.
Yeah, that's interesting. How does the PSM fit into this? Because like what you're saying, it sounds like you're like it's not factoring in the PSM. Like, doesn't the PSM also kind of fix the problem?
The PSM only works when the DSR is at 0. So pretty much the DSR goes to 0, and then the PSM kicks in. But what happens if DAI drops below $1? The PSM, if it's already been cleared out, all those billions, then if the peg drops below $1, you can't use the PSM anymore to set the peg back. So pretty much Maker, this happened in 2019. The only way Maker can get the peg back on track if DAI drops below $1 is by hiking the interest rate, and it has to do it aggressively. Because if it doesn't do it aggressively, the DAI peg breaks, people lose confidence, everyone goes crazy. So what if you have that 2019 scenario where you need to get a little bit hawkish, and meanwhile you just promise your best client these low fixed rates? That's the core of the issue which we set out to solve.
Yeah, and I would like to extend on that a little bit. I mean, I think Akiva's right, especially in terms of the angle he was approaching it from. But in terms of the TLM, one thing is, of course, Maker controls the rates at which it's buying via the TLM. And so it can raise those rates at any time via governance process. And so you could imagine, in the same call that you're deciding, okay, here's where, the ETH rate is, or here's what the DSR is, you could decide, okay, what is our rates for the TLM? So you can change those and raise and lower those as appropriate to affect monetary policy. It doesn't change, the rate somebody has already previously locked in via the TLM, but it would change all future rates, which is a powerful tool itself. Then of course, if in perhaps a future version of the TLM, if Maker wants to further affect rates, it could, of course, one could imagine adding a feature where it starts selling perhaps FI tokens or these zero coupon bonds that it's bought to alter interest rates in the ecosystem. So I think that the TLM in that sense, it isn't fixed in quite the way Akiva was talking about, if you just had a fixed rate vault that you'd given someone, because, you can always change things on the margin. You're just not changing fixed rates that have already been locked in by somebody.
You're basically only setting the rates of any new maturities and new series that are coming out as they come out.
That's right.
So I asked the question, like, is there any fundamental problem with Maker setting both variable and fixed rate products? Like I'm curious, like, is there a way to, like, is there some sort of conflict of interest there? I remember at the beginning of the call, like Akiva talked a bit about the separation of certain activities, but I wasn't sure if this is what he was talking about.
So this is fixed rate and variable is possible. That's a lot
Okay.
of financial institutions do that. What we see as needing to be separate is the core MakerDAO business and a separate business of selling fixed rate products as a side to that. So Maker can offer it at its core level, but the actual sales function of like road shows and sales presentations and that investment dealing process needs to be kept separate. But in terms of the core Maker level, it can offer different products. Yeah.
Okay, got it. And now I understand. Thank you. Frank just posted a thing in the chat. Frank, do you wanna get on the mic?
Yeah, I just said I have a lot of background noise. The jungle out here. Yeah, so I was just wondering, most folks are focused on the fact that it seems like there's not a lot of appetite for fixed rates, right? So most people haven't really thought about the technical challenges associated with such. And I was wondering if you guys, I could bring up anything that comes to mind that's in reference to that technical challenges when integrating with the Maker sandbox. And I asked because some will say that, Vamsi, a former foundation employee and also PE core unit team member, probably knows the system better than most of us on this call. I think I haven't checked everyone in here. So yeah, hopefully you get the drift of my question.
Yeah. So there are different challenges in setting fixed rates, technical challenges aside from the business and monetary challenges. So one thing is just computing, just like simple computations of what the interest rate is. Maker, everything is compounding on an instantaneous basis. So there are some challenges there. That being said, we have engaged the best developers to be able to address that. Mathematicians and whatnot who can calculate the per second interest compounding. There's also technical considerations around the components of a vault interest rate. That's a challenge. What we've done actually to address that and to actually make it a good experience for our clients is we built simulations. So we run forks of the blockchain all the time, which actually fork the MakerDAO code, go into it and start playing with all the interest rates. And what we do, this is all on test nets, on mainnet forks and whatnot, not the main chain. And we play with the interest rate and we test to see whether or not our calculations are accurate. And what we've done, and we run this for clients all the time, is we show these little charts of where the DSR goes up and down and all around. And what we find is that no matter where the DSR goes, if it's all the way up, all the way down, back and forth, we can always calculate and achieve the correct balancing. And we think that activity actually helps us in our will and does help us in sales.
Nice. So we have about 1 minute left to the top of the hour. This was a very fascinating call. We hit on a lot of very related but spread about points. And I think the goal of this call was to get the attendees and the viewers to have, to get a little bit of a better understanding about the differences and kind of the current status of each of these protocols and the trade-offs between each. And I think for me as the host, even there's still a lot of open gaps in my understanding. So I can imagine how a viewer or a voter is also approaching this. So I just want to caution with, if you are voting, if you are considering these solutions, don't just rely on this call. There's a ton of additional resources from all three solutions, from Yield, from Pairwyse, and from Deco. I think as we progress, we're going to be able to compare and contrast the solutions more. And so, yeah, I hope this was super helpful. And I'm going to give it over to Akiva and Allan just to give their final contact info if anybody's interested in following up. And also just want to thank you, gentlemen. Thank you so much for coming on the call, for taking your time out of your day to speak with the MakerDAO community, to speak with us, and to dive into these really interesting, complex, and important topics.
Thanks, David. I'm happy to give a place for people to find more information about us. You can learn more about Yield at Yield, HTTP, :/ yield.is. Soon we'll be live at yieldprotocol.com. You can follow us on Twitter at Yield.
Yeah, thanks, David. I just posted my email in the chat. It's akiva@akiva.capital. That's akiva@akiva.capital. And I look forward to hearing from you guys.
Yeah, right on. And all of these links are found in the call notes. So you could find those on the forum. Anybody with a link can view, and those will exist into perpetuity. So yeah, I thank you guys again and look forward to our next interactions. Take care.